This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
Again, hopefully it won't take long, but listen, there'll always be several questions on this. But accounting standard number 1 is presentation of financial statements. And it's in accounting standard number 1, in fact, where you have the layout of the balance sheet, the income statement, but we've already said enough about that last time, whatever, okay? But also in accounting standard number 1, they list various concepts of accounting. And what I mean by concepts is this saying when any accountant is preparing a set of accounts, there are various, what you might call, really basic principles that we always apply. And they mention loads of them. In these 2-3 pages, I've listed the ones that are important for the exam. But the sort of thing I mean for it, what I'm getting at, well, the most important, they first of all start off with saying there are 4 fundamental ones that are the most basic rules of all for anybody producing accounts. That first of all, fair presentation. Oh, I'm not going to write down because it says though. Fair presentation. Again, Inessa, this is back to being a matter of opinion. But they're saying this. Hello? That if an accountant prepares a set of accounts, the income statement, the balance sheet, their job is to try and show the true position. It's not, I think I mentioned before for a different reason, the accountant shouldn't be trying to make things look better than they really are, or things look worse than they really are. Their job is to show the true position, to present things fairly. All right? Are you understanding me? Why do you all look asleep? Oh, I'll wait till it gets till 6 o'clock, and then it's because you're too hot. I'll turn that off in a minute. No. And the point is, I've seen sets of accounts, I don't know if you have, where you open these nice glossy booklets, and at a quick glance you look at the big figures, and oh, there's a great big profit figure. Looks wonderful. But then, in smaller print, there's something else mentioned, and the final profit's actually a lot lower. And they, in a sense, they're trying to cheat. The correct profit figure ends up being there, but just even the way they've presented it, they've made it, at a quick glance, look better than it really is. Well, the accountant's supposed to be almost independent. The trouble is, in real life, of course, if your managing director says, can you make things look a bit better? Well, as an accountant, you should turn around and say, no. I'll do what's honest, and true. But of course, if your managing director insists, the trouble is you do what you're told. But anyway, an accountant's job, they should present things fairly, honestly, truthfully. They're not trying to make it look better or worse. All right? Secondly, going concern. I say these are the fundamental ones. So although there's loads they can ask, it's these 4 more than any that have to be asked. Not always all 4. But going concern, I have typed, means we assume when we prepare accounts that the business is going to continue. What I mean by that is this. Let me give you one example. How do we value inventories? The rule is you value inventories at the lower of cost and selling price, basically. Do you agree? And obviously, For most businesses, for most items, you're going to sell at more than cost. You'll normally be valuing at cost. Would you agree? Hello? Yes. But if I told you my business was about to close down, well, of course, if a business is going to close down, they very likely have to sell things off cheap. True? Well, when we prepare accounts, normally we assume the business will continue. You don't start saying, oh, but we might have to sell things off cheap because we might close down. Do you see my point? Now, before anybody shouts, clearly there can be situations when you're about to close down. Well, if that's the case, the accountant should write a note. There should be a note saying, this company's about to collapse. And so we've not valued as a going concern. But of course, then there's a problem. If the accountant writes that in the accounts, that makes pretty certain the company will collapse, you know. But anyway, the basic rule is you value things on the assumption that you'll continue in business. The third one, the accruals concept. You know what the word accruals means, but the accruals concept means slightly more. The accruals concept, I know I've typed a bit, but can you listen? First of all, you bring in all income earned so we don't just bring in, like some people used to want to, just the cash we've received. You know from everything we've done in the debits credits, you bring in all the sales you've made, whether you've had the cash or not. Do you agree? Similarly, you charge all expenses incurred So again, it's standard basic accounting, obviously. You don't just have as an expense the amount paid. You bring in your total expenses. You have accruals, you have prepayments and so on. True? But the third thing it means, very importantly, you match costs to revenues. Now what I mean by that, and the example of that, match costs, to revenues. What I mean by that is depreciation. That's the best example of the accruals concept. You see, if I spend 20,000 on a machine, why don't we just have 20,000 expense this year? It's because if that machine is going to last 10 years, if it's going to earn me income for 10 years, then we'll spread the cost over 10 years. And how do we do it? We depreciate. You see what I mean? That's the accruals concept. Now some of you are pulling funny faces, but understand me, I've spent 10,000 on a machine. It's a cost. But of course, you don't have 10,000 expense this year. If it's going to earn me money for 10 years, you depreciate over 10 years. You have a bit of cost each year as you're getting the revenue. You see my point? It's a basic, fundamental concept of accounting. That you're matching. You bring in all your income, you bring in all your revenue. Anyway, I think I've said enough. The final fundamental concept, and sorry, because they're fundamental, this is why I'm spending more time on them, is consistency. This means two things. The word consistent means same. Something's consistent if it's the same, all right? And this means two separate things. Number one, we treat all similar items the same way. But I've already given you the best example of that last time. It's depreciation. Did I not say last time that you must depreciate all cars the same way? You can't depreciate one car one way and another car another way. Do you remember? That's what I mean. So, for example, depreciate all cars the same way. Oh, sorry, depreciate all cars the same way. But anyway. The other meaning of consistency, the other thing it means, is that we must do things the same way each year. And again, depreciation is the best example. I said again last time that you can't keep changing your depreciation policy. If cars are 20% straight line, well, you keep it at 20% straight line. You understand me? So it's up to you whether you bother writing. But depreciate the same way each year. All right, now those are the four fundamental ones. And although, again, any of these I'm coming to can be mentioned, those four, maybe not all of them, but there have to be some questions, certainly on some of those four. Incidentally, before I move over, and the others will be much quicker, I did say last time there might be very good reasons for changing depreciation, for example. Do you agree? Well, the standard says that any set of accounts, you assume those four concepts have been applied, unless there's a note saying different. If for any reason you do different, change depreciation, for example, there has to be a note explaining. If there isn't a note, you can assume that in any set of accounts they've applied those four concepts. Are we clear? All right, they're the fundamental ones. Over the page, you've got a whole list. Now, some of these are very obvious, some slightly less so. Can we just run down and make sure we're clear? The first one there, materiality. The word materiality is basically big. And what they say is this. Disclose big items separately. Show small items in total. Let me give you an example of what I mean. Receivables at the end of the year. I might have receivables at the end of the year of 50,000. It's 1,000 from Liga. It's 2,000 from Irina. It's 3,000 from Oksana, and so on. But obviously, my balance sheet, I don't show every single receivable. Do you agree? I just show total receivables. However, if I were to tell you my receivables are 50,000, but 40,000 of it is INASA, Well, all the others are small, Innes is big, if you understand me. I'd make a note. I'd make a note that, all right, receivables are 50,000, but there'll be a note to the account saying, there is one receivable owing me 40,000. For me, that's big. Again, am I making sense without me writing an essay? The big question, of course, is what's big, what's small. The accounting standard doesn't define it. There is no definition in accounts of materiality. There is for auditing, but not for accounting. It depends on the company, and it's judgment again. For me, 40,000 is huge. It's material. Maybe for your company, 40,000 is fairly small. You know, you have lots of people owing 40,000. It's not. So there's no definition. You can't be asked to define it. But, have I made the point, please? Everybody? Or in the income statement. Think about this in your income statement. You have admin expenses. It's the total of millions of things. You don't put a list. But if my admin expenses were 100,000 and 90,000 of it was the wages of one person, I'd make a note. You know, because that's material, that's big. Okay? All right, next one. Relevance. Here, 10 seconds. The accountant should put in the accounts anything that's relevant to the users. It's just a concept. You know, you don't need special rules. But you're preparing it. People are going to use these accounts. You should put in it what you think is relevant information for them. If it's not relevant, we don't put it there. You know? Your job is to give users information. What do they need? Fine, we give it them. Don't stare at me. Yeah? It's just trying to define your job. And equally, reliability. Are we happy with what the word reliable means? It means you can trust it. Yeah? Well, I think fairly obviously. The accountant, the accounts you should be able to trust. They should be reliable. They should be accurate. Okay? Next one is actually repeating one of the fundamental ones. Faithful representation. It simply means honest, truthful. That it really is a repeat. We're not trying to make things look better or worse. We're trying to show an honest, a truthful, a faithful view of the business. Are we all still awake? Next one. Substance over form. This is an important one. Here, only very briefly. Later exams, it becomes much more important. Before I write down, let me give you an example. Irina and I have exactly the same sort of business. Exactly. We both are using a big machine. She's bought the machine and it cost 100,000. She's bought it. It's sat on her balance sheet. 100,000. I use exactly the same machine, but I rent it. I lease it. Yeah? I don't own it. Well, anybody comparing our accounts, it's going to look a bit funny. We're exactly the same business, using exactly the same machine, making exactly the same profit. And yet they look at her balance sheet, and she's got this huge asset costing 100,000. They look at my balance sheet, I'm making the same profit, and there's no asset. You know, think about your ratios. Yeah? It's going to look really weird. Well, the accounting standard says that it doesn't matter who legally owns that machine. It's irrelevant. What you should show in the accounts is what the actual effect is. And even though legally I don't own it, you're all still with me here? If I'm using that machine just as though it is mine, it's in my building, yeah? I'm controlling the machine. All right, I don't own it. I know I don't, but I'm using it. I'm having to pay rent. But the rent is very much, it's just as though I'd borrowed money and I'm paying interest, you know? Well, the accounting standard says, if you're using it as though it's your machine, you should show it on the balance sheet as though it's your machine. It doesn't matter what the law says, okay? And that's what substance over form means. It means in the accounts, we show the substance, show the true effect. And I think you know what I mean by that. If I'm using this machine, it's as though it's mine. Yeah? That's more important than the legal position. Form is the legal position. Of course, there aren't many cases where the two are different, but there was a basic example. I don't care who legally owns it. If I'm using it as though it's mine, it must appear in my balance sheet. Okay? Next one. Neutrality. It's again a repeat. Neutrality. No bias. You'll have to help me here with the English. I don't know how many words are obvious or not. If you're neutral, there's no bias. It means what I said before. You're not trying to make things look better or worse. You're neutral. Now, it's hard for me, please. I honestly, when there's English, are we understanding me here, aren't we? Mm-hmm. Oksana, Irina? Yeah. Next one. Oh, prudence. Prudence is a very old-fashioned lady's name in England. Here, though, it's nothing to do with ladies' names. Prudence is another word for being cautious, being safe. Be cautious. Cautious? Safe? If you've got children, when you're crossing the road, you teach them to look both ways. Yeah? To be prudent. Well, the relevance in accounting is two things. One is, you only record income when certain. Oh, do you remember when we talked about contingent assets? We might be getting money. If you look back at the table, if you might be getting money, you don't show it in your accounts unless you're virtually certain. All right? But at the same time, to be safe, you record losses as soon as expected. Or as soon as you see they might happen. Think of contingent liabilities. If you look back at the table, with contingent liabilities, even though we're not certain we'll have to pay, we still show it to be safe. Do you remember? Well, that's prudence. Completeness. Well, you understand the word complete, obviously. We show all the information. We don't just miss bits out because it doesn't look very nice. Yeah? I think that stands to reason. Over the page, comparability. Well, all that means, you've seen, you all know, we've seen this week. You show this year's figures, last year's figures, so that people can compare. Hello? You are all asleep. Come on, we're nearly there. Wakey, wakey. And finally, understandability. You may think this is over obvious, and perhaps it is. But a lot of people don't realise the accountant's job is not just to present the numbers, obviously accurately, reliably, everything else, yeah? But the accountant should try and make them understandable to an ordinary person. A lot don't. You look at accounts, and no ordinary person would understand what was going on, you know. But the accountant's job is to try and make them easy to understand. The accounting standard uses words like, for somebody with reasonable business knowledge. So you shouldn't need to be an expert to understand a set of accounts. It's the accountant's job to try and make it easy for a non-expert to understand. Yeah? All right, well, that's not all the concepts mentioned, but certainly they're the ones you need for the exam. They'll never ask all of those, but there'll always be a few questions just checking. Things like, an example of prudence is... Ooh, contingent assets only show when we're certain. Something else, something else, something else. Just to check. You knew what it meant, yeah? Agita, yeah? She's got to say yes, otherwise she knows I'll carry on talking forever. All right, very last of all, and please, come on, I know you may be tired. I know it's hot. That's your fault for getting me to bring the heater in.
No, it's warm.
Well, that's your fault for not sitting near it. I know it's Friday. I'm going to let you go home early on one condition. That you all sit up, wake up, and listen to the very last bit. This bit that's headed Alternative Valuation Bases. Listen to me, because this is asked in virtually every exam. There's only 2 questions they can ask. You can learn the answer almost. One of the 2 questions is bound to be asked, and it's 2 marks that a monkey could get. All right? If they ask this and any of you get it wrong and fail, I will kick you in the head. All right? Because it's because you're sleeping for the next 2 minutes. Alternative valuation basis. What it is this. Just listen and then I'll tell you what they'll ask. For years, ever since I studied for my exams, university people have been arguing that we should do our accounting differently. They've been arguing that, you know, it would be much better if we did things differently. And what they're arguing about is this. If I buy a machine, how do we value it in our accounts? You value it at original cost less depreciation. Do you agree? That's what we've always done. And yet, of course, you know full well, we've said 20 times, the value in the balance sheet doesn't really mean anything. It's not the true value. Do you agree? And I say university people have been arguing for ages for obvious reasons. That shouldn't we do different? Wouldn't it be much fairer, sensible, whatever, to use the true value. Yeah? Hello? They've been suggesting different ways. Well, we've never changed. We still use cost less depreciation. But universities keep saying, wouldn't it be fairer to show the real value? You know? And so on. Well, the way we use cost less depreciation, whether it's good or bad, is called historical cost. Historical cost is the way we do our accounting. It means you value non-current assets at original cost less depreciation. And what I hardly need write down, but because I said there are two questions they can ask, appreciate, this is the method we use. This is the way we do it. And that's one question of the two she can ask you. She'll say, which method of accounting do we use? Historical cost, replacement, net realisable value, economic value. Well, although I'll tell you briefly what the other three mean, she'll never ask you what they mean. It's simply, we use historical cost. Original cost, less depreciation. Okay? I'll tell you briefly what the other three mean out of interest, but you will not be tested on it because we don't use the other three ways. Replacement cost, one suggestion is that the value in the balance sheet, you should put how much it would cost to buy a new machine. Hello? They'll change all our accounting. Go on, don't worry, we're not going to do it. But they say, when I do my balance sheet, I've got a computer on mine. Well, I value it at the cost less depreciation, yeah? One suggestion is that I should find out how much a new one would cost and use that value in the balance sheet. Okay? Don't worry about debits, credits. We don't do it. We're not going to do it. But that's what it means. Realisable value, this is an obvious one, is to say, why don't we put in the balance sheet how much we could sell it for? Yep, that's an obvious one. We don't, we're not going to, but that's what it means. You with me? Now you're writing down, which is fair enough, but she will not test you what these mean. I'm telling you out of interest. We do not do it that way. You do not value it at how much you could sell it for. You do not value it at how much a new one would cost. All right? The last way, economic value, would be a real bastard. What economic value is this? I say, I've got this machine. How much do I think it's going to earn me? I think this machine might earn me 2,000 a year for the next 10 years. And then we try and work out how much is that worth to us, 2,000 a year for 10 years. Some of you have heard of discounted cash flow. Maybe? Don't worry, that doesn't come till paper F9. But you'd have to actually work out how much did you think we were going to earn and value it at that amount. It would be awful. However, as I say, although they're all suggestions, when you get to P2 you could argue about what's good, what's bad. We use historic cost. And there's one question. Are we clear? That's easy. The other question needs a little bit of thought. Let me write it down. You think for a minute, see if you can tell me the answer. It's not every time, but it's common. In times of high inflation, do you remember those days? No, obviously not. You know what I mean by high inflation? In times of high inflation, I want to know two things. Historic cost accounting, the way we do it, historical cost, the way we do our accounting tends to, number one, over or under value assets in the balance sheet. Which, with high inflation, is the value of your machines in the balance sheet. Are you likely to be overvaluing, overstating, or understating? Everybody? Well, Irina was right. I don't know if you heard her. Surely, in times of high inflation, you're going to be undervaluing, understating. You're showing what they originally cost. If there's high inflation, these days things are likely to be costing a lot more. Do you agree? And so historic cost accounting tends to undervalue or understate, same thing, assets in the balance sheet. Now there's one more bit to this, but is that bit clear to everybody? It obviously is to Irina. Is it clear to you, Liga?
Yes.
Oksana? Yes? Agita?
Yep.
What about this though? In times of high inflation, historic cost accounting tends to undervalue assets in the balance sheet. It also tends to over or under state profit in the income statement. Which? It's less obvious. But if there's high inflation, is our way of valuing assets likely to show too much profit or too little profit? She's right, and why?
Because we are valuing assets lower.
Okay, yeah. All right, well, I think she's right. I think she means for the right reason. The point is this. In your income statement, you'll have depreciation as an expense. We base our depreciation on the original cost. True? We say the cost of using it. It cost me 1,000, it's lasting 10 years, it's costing me 100 a year. But of course, in times of high inflation, the asset these days had cost a lot more. If the asset was costing a lot more, the depreciation would be a lot higher. Do you agree? You'd have a higher expense, you'd have lower profit. And so, historic cost accounting, you're charging low depreciation based on the original cost. Lower expense means higher profit. It overstates profit in the income statement. She won't ask you why, but if you go home and it worries you because you are asleep, it's because low cost means low depreciation. I say she won't ask you why, but this is the other question. She says in times of high inflation, historic cost accounting tends to, and then she gives you 4 choices. Overvalue assets, overstate profit. Overvalue assets, understate profit. Undervalue assets, overstate profit, undervalue. You understand me? And the correct answer, it understates the value in the balance sheet, which I think is the more obvious. and I hope you're clear, but I think it is that slightly a bit less obvious. It overstates the profit in the income statement. Okay? And that's why universities have wanted us to do it different, and it's quite funny. They always start arguing when there's high inflation. I remember a time inflation was very high, and they nearly won. They were actually coming out with accounting standards. We were going to change the way we did our accounting. It would have been awful. Thankfully, high inflation suddenly stopped, and they all decided, oh, there's no point, it doesn't matter anymore. And we didn't change. But you should have seen the statement they were coming out with, the standard. You think basic accounting's easy? If you'd have seen their proposed standard on dealing with inflation, it was awful. All right? Be grateful, Irina. Otherwise, F3 would be a complete nightmare. Anyway. All right. So there you've guaranteed 2 marks. If you're lucky, 4, 2 questions. But which way do we use historic cost accounting? And make sure you've got that down. As I say, if you were asleep, fine, I don't care. But make sure you've got it down, you think about it, and then it becomes easy. Okay? There is one more page, a different standard, but it's very, very unlikely. I'm not going to talk through it. You can read it yourself. Okay?